Welcome to the daily update, where I'll go over the action in the market for Wednesday, July 31st, and then we'll see how things look for Thursday, August 1st. Well, there are times and there are books out there that talk about how there's a random nature to the market. A book that I'm thinking of is called A Random Walk Down Wall Street. Very popular book, recommend it to anybody. Well, somebody else wrote a non-random book to Wall Street, which is a lot pricier, and that's based on the idea that there's not always a random nature behind the market. Well, we're kind of going through one of those random times because it looks like, okay, we're shifting and going higher, and then we have a pretty significant downward move. And then it looks like, okay, we're turning more negative, and then we have a solid up move, especially ahead of a big announcement like on Wednesday with the Fed. Again, not much real speculation on what they were going to do with interest rates, but it was what were they going to say? And the market could have went either way on that because they didn't really feed into this idea of a rate cut in September with their statement, but they didn't discount it either. So this has been a pretty difficult market to navigate through. We're still looking negative on a lot of different time frames, especially the intermediate term, but we're above the 50 period moving average. We're also still below the 20 period simple moving average, but above the exponential moving average. Some things are showing some strength, some things are showing some weakness. We saw small caps pulling back, where the mega caps, semiconductors, and growth stocks had a really solid up day. The futures look pretty strong before Thursday's session after earnings have been coming out. We have the big employment situation coming out on Friday. There's a lot of things that the market is taking in right now, and it's kind of produced this more random walk type of thing that we're seeing these days. I do have a thing called the SPXInvesting Program. It has launched. It's freely available. Now that August is coming around, I'm looking at locking that down. So if you want to check it out, it's still free for the time being. As soon as I get things set up in a little different way, I'm going to be locking it down where it will require you to log in to actually access the information on the site. If you want to learn more about the program itself, here's a link to some videos in the description. There's also a link that will take you to the website. Here's an email address if you want to talk to me about it. The daily video is really the foundation of everything that I do. I get new people watching the videos all the time. That's why I feel I need to go through this. Also, over the weekend, when folks have more time to sit down and go, what's going on in the market? They have a real tendency to go to the weekly videos that I do. So I like to explain there that the weekly video is just one part of the overall picture that I tried to develop as we're analyzing the market. Okay, what happened? We had a gap higher open. The futures were strong, and it just kind of kept going. We opened above 5,500 and we hit resistance up at R2 at 5,530. And then we drifted slightly lower. And that's when the market finally decided to settle down and wait for the Fed announcement at 2 p.m. Eastern. Then, right before the announcement came out, prices were trying to front run this a little bit. We got back up to R2, and then we shot up to 55.50 after the announcement. That was the high. We ended up reversing at that point, and we pretty much closed at the pre-announcement level. So the gyration that we saw afterwards was pretty much like being on a treadmill. We ended at the same place we started, but we were up 1.58% on above average volume. So a pretty solid up day and an upward move. We are still negative in the short term if you want to count the 20 period simple moving average. We're looking a little bit better. Things are improving. We're negative in the intermediate term, but we're above the 50 period moving average. And all the interest rate stuff that came out, really nothing new in that whole area. A lot may be coming out, and the market's going to try to make some conclusions based on there's the ISM manufacturing that'll be coming out on Thursday, and then the employment situation on Friday. And then sprinkled in all of this are earnings reports that are being released. Okay, what are some comments? Well, this is just the opposite of what we said after Tuesday. On Wednesday, mega cap semiconductors and growth stocks were strong. They were weak on Tuesday. What are they going to be on Thursday? Just flip a coin and you've got just as much of a chance of figuring that out. We are starting to get extreme negative with our slope oscillator. Even with this move up that we saw, the oscillators and our momentum is still negative. Intermediate term, we already have a couple of overbought indicators. The bullish percent index for the S&P, and this one's been holding up. Even as we were declining, that was suggesting that the rest of the stocks outside of the Magnificent Seven were holding up the S&P quite well. Well, with the upward move, now we're getting to an extreme reading. And longer term, the 10-period moving average of the new highs, new lows, it's still showing that there's good momentum there. And on a long-term basis, we're above the 150 and 200 period moving averages. Now, that's suggesting good momentum, but I have some areas that once we get above those areas, we just want to make note of that because they're looking rather extreme. I haven't made any changes to this whole scenario yet. They didn't change rates, which was not a surprise. They didn't really say anything that was all that much changing. That's why the market pretty much started and ended at the same spot before the Fed made their announcement. The dollar was down and interest rates were down. This gave support to stocks. We closed at 4.11% with a 10-year yield, where we had been at 4.14%. We're still inverted with those yield curves. This is what we're going to be watching for in Friday's session with the employment situation report, depending on how that comes out. If it's showing that employment is weakening, we might eventually see the yield curves going back to being normal after being inverted for a couple of years. Sentiment is back up to neutral. We had been at 42. We ticked all the way up to 52. And we're still negative with our trend. The ADX is still below its moving average, but we're above 20. So we are in a trending environment, but it's a weakening trend. With the up day, our bias is positive. I'm still keeping our momentum at mixed. You could probably make that mixed to positive, but after Tuesday, you could have said mixed to negative. Okay, economic reports. We see this every week. The MBA mortgage applications index, it was down 3.9%. Last time it was down 2.2%. The ADP employment change came in weaker than expected at 122,000. They expected 160,000. Last time it was at 155,000. The cost index for the second quarter came in up 0.9%, which was less than the 1% they thought was going to happen, and down from the 1.2% that we saw last time. Pending home sales came in up 4.8%. They expected them to be up 1.5%. Last time they were down 1.9%. The Chicago PMI came in at 45.3, down from the 47.4 that we saw last time. And here are some charts. The weekly chart here showing how the mortgage applications have been dropping off. The employment change also, it's still positive, but it has been declining if you go back to March. The Chicago PMI also declined as well, and we're under that 50 level, showing a contraction. And then first looking at the year-over-year pending home sales, improving, but still negative. But then month over month, we saw an increase. The employment cost index, and this is broken out into three areas. The total reading is the blue line where it's coming down. And as stockholders, we like that. We want companies to make more money and have fewer expenses. But if you work at one of these companies, you want it just to be the opposite. You're like, pay me more, pay me more. Where the yellow line are wages, and those are decreasing. The benefits are pretty much flattening out, but they had been declining. Then some Isabel Net blog charts here. We're pulling back a little bit here with the S&P. Now, I'm seeing this as a little bit different, but this came out before Wednesday's session. We're getting above this 80 level now. But what I was noticing and pointing out in the chart of this that I use is that even when the S&P had been under some weakness, the bullish percent index had been holding up. We look at the buybacks, still looking healthy, even though it's dropping off just a little bit here. And then what is the performance before the Fed starts to cut rates and then after? And I mean, everybody has their opinion, but you could say, okay, here we go up, here we go down. I mean, flip a coin there. And then looking at gold, it's down 8% against the Japanese yen in the past 2 weeks. Just kind of an interesting thing there. And then by sector, where are we seeing money going in? Where are we seeing it going out? Lots going into ETFs, and that's what tends to happen when we're in a trending environment. The indexes tend to do better than the more managed type of ETFs or mutual funds. You can just ride the index. Where when we get into difficult times, that's when more managed ETFs, something like ARK or something that's more defensive, that's when they tend to do better because the managers of either the mutual funds or the ETFs, they have more latitude with what they can do. They can move things around. Where when we're declining, the index is just they're going up or they're going down. We're seeing communication services, a lot of money going in there as far in discretionary as well as healthcare, and then kind of some middle areas. We're seeing a lot of money coming out of tech recently as there's been a pullback. And of course, then we shoot to the moon in the tech sector on Wednesday. Isn't that interesting? And only 5% of firms currently use AI, suggesting limited growth. I don't agree with that last statement, suggesting limited growth. Okay, so much of our lives now are web-based, but there was probably 0.5% of companies that actually used the internet when it was first coming out. We're just getting off the ground with AI. So, no, there's not a lot of companies that have really decided to implement it yet, but they probably will as it becomes more streamlined, as it gets more of standardization. What are we going to go with? What version? It's like beta, VHS, the different formats of things. So I think this is going to work out much differently as we go forward, but that's an opinion. Okay, risky versus safe assets. We're above the line over here. That means folks are still more risk on right now. They're willing to put their money at risk to get better returns. Earnings sentiment, looking here, the one that we pay attention to is S&P 500, where we're negative here, and we've been shopping more or less sideways here when you compare it to the rest of the world. All right, I don't have any charts of interest today, and I didn't spend any time on Twitter. I've been just totally consumed with other things involved in the program. Let's look at the intraday chart, where a lot of the gains were seen with the huge gap higher. We were above 5,500. Right at the open, we got up to R2. We didn't even blink at R1. We never hit that spot. And then we pretty much topped out here at R2. We drifted lower and then drifted a little bit higher. Here's the announcement, which took us up to 5,550, and then we dropped back down. Then we came back up and pretty much closed right where we were at R2 before the announcement was made. Intraday, we are looking more positive now. More earnings reports have been coming out, and the futures do look positive. We'll see how much that carries through into the open for Thursday's session. And we're still seeing where the blue line is below the red line, even though value came down and growth went up on an intraday basis. They're still showing that value is outperforming. We saw a little bit of an improvement here with the growth to value ratio intraday for the S&P, but overall, if you go back more to the earlier parts of July, this has been declining for the most part. Our end of day charts growth just had a massive update, up 2.69%, where value was up 0.2%. Growth was up more with the mid caps and also up more with the small caps, but this is right now looking like a one-day wonder. We saw the opposite of this on Tuesday. What's going to happen on Thursday? Well, we'll just have to wait and see. So saw a little bit of a tick up here, but not seeing a big shift when we look at small cap growth to value. Also the same thing with mid cap growth to value and even S&P growth to value. Now, this is interesting, and this is something we're just kind of keeping an eye on right now. When we look at this ratio of growth to value, notice how we came down to the 250-day moving average. We did that before back in April, and then we bounced up off of that, and we're able to come up out of that weakness that we had been seeing. We came down to the 250-day moving average again, and we're bouncing up. So is this the start of something? We don't know yet. We're just kind of keeping an eye on this. We also saw this with home construction, where when you compare it with 3 to 7 year bonds. It came down to the 250-day moving average with the ratio, and then boom, has taken off and has done really well ever since. So we'll just watch this and look at other areas of growth versus value to see if they're also improving. And we saw a bit of a tick up here, but not a real shift when we compare discretionary with staples. Large cap growth is coming back up and getting to its 50-day moving average again. So it was a nice up thrust day there. We're ticking back up when we compare large caps with small caps after we had been seeing a real decline with this ratio as small caps were outperforming. They didn't outperform on Wednesday. The Wilshire, and this may be where we're getting some support from. We actually broke below the 50-day moving average on the S&P. We're well below it with the QQQs. Maybe it's a broader market measure here like the Wilshire, where we held up above the 50-day moving average, and now we're starting to come up off of that. Keeping an eye on our trend, we are still negative. The ADX is declining and below its moving average. That's a weakening trend. The red line is on top, even though it's declining, but we still default to negative here. And we almost got to a cross here. If we had had a down day on Wednesday, we probably would be in a strengthening trend, at least on a short-term basis. But we're still below the moving average for right now, and the red line is declining. So we still default to negative in the short term. We were above average with volume, where we have typically seen a drop-off, but we're just not seeing that much right now, both for the NYSE and the NASDAQ. We did get the latest reading from Investors Intelligence. They had been above 4. That's usually when we get a little bit nervous. It dropped down to 3.81 as of the latest reading. The Ulcer Index is still showing that there's a lot of fear in the market, and we might have overdone it on a one-day rate of change where we were down on Tuesday, up on Wednesday. Now, we've been higher than this before, and it doesn't mean we're going to see a reversal necessarily. It just means that we saw a pretty solid upward move after we had been chopping more or less sideways along the 50-day moving average. We did decline with the VIX on a closing basis as well as the bar chart. And we also declined with the update with the VIX of the VIX. But the momentum, even though it's rolling over, continues to be up for the VIX. And we also see a historical seasonal pattern here where the VIX tends to rise going into about the middle or so of October. We did decline with the one-day equity put call ratio. We're now turning back down with the 5-day, but we're still going up with the 10-day chart. And volatility risk premium is right again at the lower end of this band. That's really dropped down as well. We declined with this fear gauge, and we also went down just slightly. Actually, we ticked up just a little bit with this other fear gauge. So seeing a little bit of contradiction there. After really falling down to the bottom end of this range that we've been in when we measure risk on versus risk off, we did come back up with the solid update that we saw. And based on price, the advanced decline line is looking really good, but we are still seeing this negative divergence when we compare it with volume. It isn't showing an awful lot of strength right now, but not necessarily an awful lot of weakness either. And we did see a drop off in the new highs after we really saw a big thrust up in Tuesday's session, but it's still showing that the new highs are doing quite well. But we're going sideways now with our 5-period, and we continue to go down with the 10-period moving average. And it's not so much that new lows are expanding, it's just that new highs have been contracting. That's why these moving averages are declining. We're positive here with the advanced decline ratio. And this is a little bit misleading here. Usually when we cross back above this midpoint here, that means we're crossing back above the moving average. You can obviously see that's not what's happening. We are seeing an improvement with the accumulation distribution, but it has not turned back positive, at least yet. We continue to be negative here with the chicken money flow. We have a solid update, and this goes down. A little bit of a concern there. We did turn up with the chicken oscillator. We're no longer extreme negative. And when we look at the cumulative NYSE advanced decline line, had a really solid upward move there. The regular NYSE advanced decline line is now breaking out and is positive. Also, this other NYSE advanced decline line is positive. We are looking better with common stock based on price. It's now breaking out above this previous high, but you see how volume is lagging behind. That's a slight negative divergence, especially if it continues, it will become more of a negative divergence. We look at S&P cumulative advanced decline line. We are breaking out based on price, lagging behind based on volume. Another negative divergence. Where the NYSE advanced decline line, it's above the S&P itself and has been holding up better. And our advanced decline lines here, NYSE common stock up, S&P, mid caps, and small caps, all were up, all are above their moving averages. Here is the daily chart where we look like we were going to break down below the 50-day moving average. We got down to that 50, what was that, 5,400 level, 5,300 level. And then we were able to bounce up off of that. Is that going to be the start of something to get us looking more positive? And we are above average with volume down below. We're no longer extreme with the Stochk RSI, the Williams percent R, the CCI 14, or the CCI 20. They've worked off their extreme negative readings. Showing some improvement here with our 20-period moving average study. We're getting back above the green and the blue line here. If we can stay above that, that'll turn these lines back up. We did see an advance with the 20, 50, and 200 period moving averages. We're just underneath this blue line, which would be an extreme positive reading. Now, the extreme reading that I'm talking about is a simple moving average. This is an exponential moving average, and they're calculated differently. We are turning back positive with the force index. And for the first time in recent memory, we don't have any kind of extreme readings on our stochastics chart. We bounced up in the short term. We're no longer extreme in the intermediate term, and we haven't gone extreme negative in the long term. And we're right in between. The red line is the exponential moving average. Sorry, that's the simple moving average. We haven't been able to get back above that, but we did get above the blue line, which is the exponential moving average. And we're getting back above the midpoint here with our standard deviations chart. That's showing an improvement there. The balance of power ticked up, but is still negative. We're still on a no-go signal with the go, no-go system. And we came back up and closed above the midpoint with the highest high, lowest low values chart. We're still declining, though, with the TTM squeeze. And we're still below both of the lines here with our 50-period moving average study. We came right up to it. It could be acting as overhead resistance. Has not been able to break through it yet. But when we look at our 50-period moving averages, maybe we did set some kind of a base here that we'll be able to come up out of. Now, there's also fake outs with this. We can come, set a base, looks like, okay, everything's looking better, and then boom, just fall off a cliff. So we don't want to make all our decisions just based on this chart, but it is turning more positive. And we're still above the 100-period moving averages, just keeping an eye on those for the time being. We ticked up, but we're still negative with the ease of movement. We're still negative with the Arun. We're still looking pretty good here. We actually ticked down with the S&P McClellan oscillator, but we're above zero. We're still seeing a negative divergence. The summation index based on price is going up, based on volume continues to decline. And we ticked up here, still looking good with the NYSE McClellan oscillator since we're above zero. So we continue to go up based on price and volume. And we've turned positive with the Swenlin trading oscillator. We were already positive and going up based on price. We're just barely crossing over to positive based on volume. That's the positive side. Now, you could also say, wait a minute, we're seeing a negative divergence here. Volume is lagging behind price. And that's right. So that is one thing to be aware of. But on a momentum basis, we continue to decline with the PMO. But when we break it out, we're positive based on price, negative based on volume. Looking a little better here with the PMOs that are rising, starting to go up slightly with the buy signals, as well as the PMOs that are above zero. And we've gone from being neutral to positive with the Elder's Impulse system. Parabolic SAR, though, is still negative. And the slope oscillator, we're just starting to break down below this red line, meaning we're getting extreme negative. We're also continuing to decline with the MACD. So all of our oscillators continue to be negative on all the different time frames. And we're above the 50s, in between the 20s right now on our moving average tree. This is where we're breaking above this high reading here with the bullish percent index. So that could also suggest good momentum. And I was trying to point out that even when the S&P was going down, the bullish percent index was actually holding up. And that just suggests the rest of the stocks in the S&P were doing better. But we're just breaking out something fierce here with the NYSE bullish percent index. That's looking quite positive. We did turn up, but we're still negative with the NASDAQ 100 bullish percent index. The money flow is turned back to positive after dropping below 50 and being negative. We're going back up, but still negative with the ultimate oscillator. We're going down with the red line with the vortex, but we are still negative since the red line's on top. We're showing some improvement here with the RSI 14 crossing back above 50 as well as the RSI 9. And we're slowing down a little bit as we were chopping around and more of this base or sideways action is getting into the standard deviations calculation as we go back 10 periods. That's why we're seeing this coming down, but we're still above the moving average. And we were up and above an advancing moving average with on-balance volume. And we just turned up a little bit here with those stocks in the S&P above their 20-period moving average. So we still haven't seen a real up thrust yet with that. But we're going up with those stocks above their 50-period, 100-period, and 200. And we're just right on the edge of being extreme positive. Now, there are times when we can go above this and stay above this for a while. That could suggest good momentum if we see more follow-through upside. But the copy curve is still negative, another momentum oscillator. The Pring bottom fisher tried to generate a buy signal, and then we went down, and now it's trying to roll over and go away. We turn it back up and are looking more positive with the Sean trend meter. We're still negative here, not because of the cloud, but because the blue line is still below the red line when we look at the full study. We're looking positive here, though, with the broad market, with the 5-period moving average of the highs minus the lows. We're well above zero. And looking at our support and resistance, this is the weekly chart of the S&P. We had been at or below this R2 level. Well, we've been able to close back above it. Now, the most important thing is going to be where do we close on Friday? Because this is a weekly chart. If we're above this R2 level, then that's going to be positive. If we're below it, then that's going to turn this more negative. Just keeping an eye on the fib levels in case we really start to scream to the downside. And we're coming back up into this little mini rainbow here, but we still haven't been able to break above it. And showing some improvement. We're right back up to the 50% extension level here for the S&P. And looking a little more positive with the hike in ASHI. We're negative, but pointing up with the KEGI chart. The Renko chart is still negative, and the 3-line break is still negative. So there's some kind of discrepancy there. We did see enough of an upward thrust to have 3 X's drawn in, but not enough to generate a new signal. We had been really going up, and then as we were declining, we saw some O's going in here. Well, in Wednesday's session, we saw 3 X's come back. Our long-term chart still looking rather extreme with the 150 and 200 period moving averages. We're still looking positive here with the 10-day average of the S&P 500 highs minus the lows. And we've only switched over to negative or remain negative with the NASDAQ 100 in the short term. All the other indexes have switched back to positive. We're still negative in the short and intermediate term with commodities, where we've had enough of an upward move to change us back to positive on a short-term basis with the dollar. We're still negative in an intermediate term basis with the dollar. No changes here with the decision point scorecard, even though there should be. And we saw an awful lot of blue or green to set things off here as the NASDAQ was just screaming higher. Even Canada got into it there for a while. So there was some shifting around and some red later on in the day, but an awful lot of improvement did happen in Wednesday's session. Now we want to know, is there going to be some follow through to this? And we had tech and discretionary being the 2 strongest tech sectors, with tech just massively doing better at 4.2% advanced, where more of the defensive areas like staples and healthcare, they ended up being down. Looking good here with our daily score of the NYSE new highs minus the new lows. Looking good here with the equal weight outperforming the S&P weighted index. So our ratio ticked back up after it really had been declining. When this goes down, that means that the equal weight is outperforming. This going back up means the mega caps are outperforming. The Dow was up 0.25%. It didn't really enjoy the success seen in the NASDAQ 100 or the S&P, but we still remain positive here. But one thing that's a little bit of a concern, you notice how we closed well off the bar and actually down towards the lower end of the bar, even though this remains positive. We're coming back up and trying to recapture the 50-day moving average with the NASDAQ as well as the NASDAQ 100. And we've gone from being negative to neutral with the QQQs when looking at the Elder's Impulse system. The momentum for the NASDAQ 100 is ticking up a little bit, but we are still negative overall. Maybe a little too negative. We were getting down to some pretty negative readings here, and that could suggest an oversold condition. And we're coming right back up to this 23.6% fib extension here. But we're still underneath the 50-period moving average when we look at the Qs. And we're still under the 20. And the 20 is rolling over. So we need to see more follow through for the NASDAQ 100 or the QQQs to continue to show some improvement. And this is also a little bit concerning where we broke out with small caps. They were up solid and then they closed well off of their highs. And here's another look at that bar where we kind of opened and closed at about the same spot here, but they remain neutral with the Elder's Impulse system. And we're still looking good here with the RSI. When we look at the Russell 2000 small caps, we're above 50. We're above the 50-day moving average. We're continuing to roll over, though, but we're still positive with the momentum. And we came down a little bit here when we look at our ratio between small caps and the S&P 500. The mid caps also closed well off of their highs for the session, but they still remain positive with the Elder's Impulse system. And maybe this is another area of support. The total US stock ETF was able to hold up above its 50-day moving average and now could be bouncing up off of that. Apple was up 1.5%, looking fairly solid, but not an all-time high. Tesla seeing a recent golden cross here. It was up 4.25%. Nvidia was up 12.8%. Gee, do you wonder where the strength came from? But still below its 50-day moving average. Microsoft was down over 1%. And in between the two moving averages, where Meta was up 2.5%, also in between the moving averages. Amazon was up 2.9%, trying to get back up to its 50-day moving average. Google was up 0.73%, still below its 50-day moving average. And Netflix was up 0.93% and really has been trailing off here a lot lately. The FANG index came right back up to its 50-day moving average. Okay, is that going to provide overhead resistance or are we going to see some follow through here? And we came down with our staples to tech ratio after getting above the 200-day moving average. Now we're starting to pull back. We're wondering if that will continue. And when we look at the small caps to tech ratio, it looked like small caps were outperforming, which they were. We're pulling back now with this ratio when compared to the tech sector. And we continue to be in a longer-term uptrend with the dollar, even though it did decline on Wednesday. And we're seeing the short-term correlation between U.S. and outside the U.S. stocks. That's rolling over a little bit here, where we could be bottoming out with the longer-term correlation. We declined with the 10-year yield. We were up with the 10-year based on price. Seeing a bit of an improvement, but have a ways to go with our growth to value ratios with the Qs to S&P. Looked a little bit better here with discretionary to the S&P, ticked up when we compare large cap growth to large cap value, but still below a declining moving average. So a little bit of an improvement with the large caps, mid caps, and small caps, but we need to see a lot more follow through for this. We are positive with the advanced decline ratio based on price and volume, and we're still going down with our S&P to utilities ratio. And I haven't shown this in a while. We're coming down a bit here with the 2-year yield, and sometimes that will also give support to the S&P. And we came back down after going up here with our staples to S&P ratio. We want to see this continue to decline to be more positive on the S&P. We have not had a confirmation yet with the Hindenburg-Omen, and we have until Friday, August 2nd, for that to happen. But again, we're not going to learn that until Monday's session because there's a business day lag with how this chart is updated. And we're still wondering what's going to happen here with the NASDAQ as far as any Hindenburg Omen. And all the perma bears, they have their declarations that doom and gloom is just around the corner. We'll just have to see how things play out. So what's our outlook then for Thursday? During this week, we're seeing about 35% of the S&P 500 companies that are reporting. We're going to have, well, we had Meta after the close. We're going to get Amazon and Apple after Thursday. We're still negative when we take the technicals together, but we are improving and we're above the 50-period moving averages. We're going to get weekly jobless claims coming out, as well as unit per labor costs, as well as productivity, construction spending, and then the big one will be the ISM manufacturing. And then all the different crazy stuff going on here, that there's an escalation of things in Israel. There's the Olympics going on in France. There's all the political things going on in the US. Plus, there's a war between Russia, Ukraine. And so, yeah, we'll just have to see how things go in this regard. We will get the big employment report on Friday. Here is showing what the reports will be coming out and what their forecasts were at the time I took the screenshot here. Seasonality. I don't have the daily chart yet. I haven't been able to get that one from Stock Traders Almanac, but we're negative with the Dow and S&P on August 1st, where we're neutral to positive with the NASDAQ. And I won't go through the options expiration stuff now, but there's not much of an edge when you look at August. We're up 54.8% of the time, down 45.2%. Not a real lean one way or the other. I guess slightly positive. And then I don't know what to do with the seasonal charts because the whole presidential situation has changed now. But Stock Traders Almanac, Jeffrey Hirsch did some kind of a webinar or seminar or something, and these are the bullet points that were taken away that were then posted on Twitter or X. And this was done July 31st on Wednesday, where it says NASDAQ seasonal MACD sell signal, nice timing. Well, that may not have followed through through Wednesday's session. And then August is the #1 NASDAQ month during election years. That's kind of interesting. And then I have been talking about this mean reversion where you look at all the years together, and we were getting way far away from that. Well, we were pulling back down to it. They're calling that a breather that sets up the next rally. I mean, there's a lot of assumptions being made in these bullet points. More volatility ahead, the summer doldrums. That is pretty easy to predict. September to October, we do see election year weakness, and they're still anticipating that the Fed will cut rates in September, maybe 2 by year end. I don't know about that. Players have changed, but the election year path endures. That means who's running for president. The best case is 15 to 25% still in play, new highs by year end. That's what they're thinking. And then if you're into cryptos, Bitcoin summer rally on cue. See you in September. Okay, just thought I'd bring that up. And Thursday is a positive day historically, going back to what we did in 2023. This is a new one here. This is stocks tend to do well in years presidents don't run for re-election. I don't think there's a real big library of data to pull from for this. I remember 1968 when LBJ said he wasn't going to run for re-election, even though he could. And then there was Truman, who could have run for re-election but didn't. I'm not thinking of anyone else immediately here, but that's not a real solid base to pull from, in my opinion. And then what we're kind of keeping an eye out for is not only August, because we still have to go through that month, but September tends to be pretty weak seasonally. And this also suggests that we might see some weakness in September here. And then the warning signs, we're still just keeping an eye on these more defensive sectors. The growth of value, discretionary to staples, yeah, they ticked up, but we need to see more follow through. So in the meantime, they are still underperforming. The 10-day equity put call ratio is still going up. The accumulation, distribution, Chaikin money flow, and Chaikin oscillator are all still negative, and these are our smart money indicators. The parabolic SCR is negative, as well as the ease of movement, the vortex, our oscillators, the ultimate oscillator, the Koppik curve, the momentum for the NASDAQ 100, and the bullish percent index. On the positive side, the bullish percent index, yeah, it's actually been hanging in there pretty good. In fact, it's might be getting a little too good right now, but we can run this way when there's good upward momentum. Our 5-day equity put call chart is still going down. which is positive. And then our advanced decline lines are really holding up pretty well, even when we've seen these declines recently. And we're still seeing this divergence. The S&P McClellan oscillators and summation indexes going up based on price, down based on volume, where we're seeing more confirmation of price and volume when we look at the NYSE oscillators and summation indexes. And we've turned back to positive now with the Swenlin trading oscillator, even though volume is lagging behind. The bullish percent index for the NYSE, it's looking pretty solid right now. The money flow has turned back to positive after being negative. The financial sector continues to be positive as well. So our conclusion, we're still negative for the S&P, but we are improving and we're above the 50-day moving averages. In the short term, we're right in between the 20 simple and exponential moving averages. And we're above the moving averages in the intermediate term, but our charts are still not giving us an awful lot of confirmation of positive action, at least yet. But we are still positive in the long term, maybe a little too positive with our longer term moving averages, but still positive nonetheless. Thank you. I hope you have a really good day, and I will talk to you in the next video.